Does analysis addiction reduce investment success? In modern investing, information is unlimited. Charts, indicators, macro reports, earnings calls, social media commentary, everything is available instantly. While analysis is essential, excessive analysis, what we might call analysis addiction, can quietly reduce performance. Behavioral research suggests that beyond a certain point, more thinking does not improve decisions. It often makes them worse. 1. Analysis paralysis and decision fatigue. Psychologist Barry Schwartz described how excessive options and information can lead to decision paralysis. When investors constantly seek more confirmation, they delay action or miss opportunities. Overanalysis can lead to late entries, missed allocations, endless strategy revisions, chronic doubt. Clarity decreases as complexity increases. 2. The illusion of knowledge. Research by Paul Slovic shows that more information increases confidence faster than it improves accuracy. Investors who consume excessive data often feel more certain, without being more correct. This creates overconfidence, larger position sizes, more aggressive trades, increased risk exposure. More input strengthens conviction, not necessarily outcomes. 3. Overtrading and performance decline. A landmark study by Brad Barber and Terence O'Dean found that investors who traded most frequently underperformed those who traded less. Analysis addiction often triggers constant portfolio adjustments, reaction to short-term noise, higher transaction costs, tax inefficiencies. The pursuit of optimization reduces compounding. 4. Action bias, the need to do something. Behavioral economist Daniel Kahneman highlighted how humans prefer action over inaction, even when inaction is statistically superior. In markets, doing nothing feels unproductive. Sitting on cash feels wrong. Waiting feels like losing. Analysis becomes a justification for activity. 5. Complexity bias. Intelligent investors often believe that sophisticated strategies must outperform simple ones. However, many successful long-term investors, including Warren Buffett, advocate simplicity, diversification, and patience. Complexity can create false precision, narrative-driven decisions, frequent thesis updates, emotional exhaustion. Simple systems are easier to follow consistently. Why analysis addiction hurts performance. Excessive analysis increases cognitive fatigue, emotional volatility, reaction to short-term noise, transaction costs, stress levels. Meanwhile, long-term investing rewards discipline, cost control, asset allocation, time in the market, behavioral stability. The market does not pay for effort. It pays for correct positioning over time. The key insight: analysis is valuable. Analysis addiction is destructive. The difference lies in having a defined decision framework, setting analysis limits, pre-committing to rules, reducing information intake after decisions. At some point, more analysis stops improving outcomes and starts eroding them. Conclusion: yes, analysis addiction can reduce investment success. Not because analysis is harmful, but because markets contain randomness. Overconfidence grows with data. Activity often replaces discipline. Complexity increases error. Better investing is not about analyzing more. It is about analyzing enough, then executing consistently.